Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Panayiotou, certified financial planning professional, the Cap in Capitalize. And on today's episode, I am going to enlighten you on how to navigate your taxes. And we are going to get so into the weeds, you are going to be immensely thankful that I do so. But before I do so, as always, your free advice for the week, which does tie into the topic of today's discussion. Now is the time to chat with a quality CPA or EA, an enrolled agent, if you do not already have one. And no, TurboTax is not free. There is always a price to pay. Now, we're going to get into this later in the episode, but price is what you pay, value is what you get. And I can tell you that a lot of those free applications, yes, they could be correct on a number of fronts, but it pays to have a real life person check this stuff out. And because this is coming out in the heart of summer, CPAs are enjoying their summer months. They're starting to get into the networking and growth mode of their practice and enrolled agents. So if you give them a call right now, they would be more than happy to sit down with you. That does it for the free advice for the week. And we need to get into how to navigate taxes. And I will excitingly warn you that there is a lot to unpack in this episode because fortunately / unfortunately, the tax code is extraordinarily complex. It's fortunate that it's complex because it gives CPAs and enrolled agents and people like myself tremendous job security. But it is unfortunate because a lot of people simply don't know what the heck is going on. So I'm going to do my absolute best to unwind all of that so you can truly capitalize on your taxes. So let's understand the basics. How do tax brackets work? Because there's, marginal versus effective tax rates. First and foremost, the tax bracket in the United States system, it is a progressive system. So a lot of people think that if you hit the 24% tax bracket, I'm making this up, suddenly every dollar that you make is taxed at 24%. That's not actually the case. What happens is as you hike up those tax ladders, and I'm not going to go through all of them right now just because it gets a little convoluted and you can Google it. But as you go up every ladder and as you make more, each additional dollar is taxed at that appropriate bracket. So to just make math easy, let's say from making $0 to $20,000, you're taxed at 10%. And then from $20,001 to $40,000, you're taxed at 12%, so on and so forth. That's really key to know because when people ask you, oh, well, what tax bracket are you in? Now you can be that much more educated and enlightened on how to have that conversation accordingly. So the marginal tax bracket is the highest tax bracket in which you are in, like those last dollars that you make. Your effective tax bracket is the average. And so you take all of those tiers based on what you've paid in tax, you average it out. That is your effective tax rate. So to get you to understand for every dollar you earn, how much of that is going towards the tax system, that is your effective tax rate. That's really key to understand. Also, one thing too, don't spend a ton of time on that because the more time you stare at your effective tax rate or your marginal tax rate, and you see how much money of yours actually goes towards taxes, it's just very, very sad. And it's very disheartening. But there are ways to legally avoid that, which we're going to get into momentarily. What you need to understand when it comes to taxes is you're not just taxed at the same rate with every dollar that you have. There's a difference between earned income. There's a difference between capital gains. there's a difference between passively earned income. And I've had past episodes where I don't believe actually there's such thing as passive income. I think you always have to be actively involved in your money, but there is, in the eyes of the IRS, something called passive income. And without making it too complex, and I just want to put passive income off to the side, the majority of you listening are going to have two types of incomes. You're going to have ordinary income tax and you're going to have capital gains tax, which passive income does technically roll into. Ordinary income is where you are taxed based on your W-2. So your ordinary income from your everyday job, salary, hourly. For those of you that work a commission-based job, even though I know your income can be variable, it more likely than not comes through as a W-2. And there's pros to that. Ordinary income is really easy to calculate as far as what the taxes are going to be. And when you get your W-2, when you do your taxes, your CPA will take plus or minus 15 seconds max to tell you what you're going to owe for taxes. Capital gains are taxed when you incur investments. So if you own a stock and if you own it for a year or longer, you are taxed, a year and a day or longer, you are taxed at capital gains rates, which are more effective rates. If you owned it for under a year, you would be taxed at ordinary income. And there's a reason why that is. And this is kind of a quick tangent, because a lot of people wonder, why would you be rewarded for investing and earning tax on a capital gain versus ordinary income where you put your hard-earned hours into it? So let's think about this for a second. If you own a business and you buy stock, or you buy a piece of real estate, you buy some long-term investment and it grows over an extended period of time, it's not like there wasn't any risk to that. You took a risk with your capital to invest in an investment that will hopefully grow over the long run. Ordinary income, what risk are you taking? Yeah, you could be risking your body if you're in construction, or you could be risking your licenses if you're a professional, whatever the case may be. But you're really risking your day-to-day hours. There's significantly more risk in going investing in businesses or real estate, things of that nature, because there's a chance that you could lose your money. But if you invested accordingly, that business grows, you've made money, everyone is won in the long run. The capital gain incentivizes you to invest that money for a long period of time. And then if you don't, or if you just made a quick buck, ordinary income, that incentivizes you to really think about hitting that long-term capital gains rate. And we'll talk about the difference between ordinary income and capital gains later on, because there are some complexities with that. I told you this was a loaded episode, but that is the philosophy behind capital gains versus ordinary income. One thing before we move on, you can't cross-pollinate, so you can't take short-term ordinary income losses to offset long-term capital gains, things of that nature. And your CPA and your enrolled agent should know this, but if you decide to do it yourself, you just got to know this. And if you don't figure that out, the IRS will come knocking on your door. So let's go over some tax planning strategies, and specifically maximizing deductions and credits. Now, if you work for yourself, or even if you don't work for yourself, you work for a company, but you work from home, there are home office deductions that you can take. Now, I'm not going to give specific tax advice or things of that specific nature. You're going to go and need to talk to a tax professional. If you have children, there can be childcare credits. If you have student loans, or if your kids have student loans and they're still dependents, you could have education expenses in credits. That is where your CPA and or enrolled agent will come in extreme handy. And I'll tell you, just as a quick side note, if you are thinking about who you should work with, but you don't know who, shoot me a DM and I'll send you to the powers that be if you give me a little bit more information about your situation, because we work with a number of CPAs and enrolled agents across the country. Home office deductions are something that is incredibly useful. And I said it before, but I really need to repeat it. If you're self-employed, that is one of the easiest layups that you can utilize in the tax code to save a boatload in taxes that you probably don't want to pay. However, not only is it one of the easiest things to look into and get, it is also something that is the easiest to get in trouble with if you don't do it right. And if an audit comes down and the IRS is knocking on your door, you really want to make sure you don't screw that one up. And that's all I'm going to say on the housing deduction. Other deductions, and this is very, very easy, regardless if you're a high earner or not, like regardless of who you are, contributing to tax advantaged accounts, company 401k, individual retirement account, health savings account, HSA for short. For most of you, simply utilizing those three, and we're talking purely getting deductions, because if you're trying to navigate taxes, you're going to want to use tax deferred and tax deductible vehicles in order to do so. I don't want to get it more complex than it needs to. For 99% of you, simply using those three vehicles I mentioned, 401k or a 403b or 457 if you work for a nonprofit or a public school or a governmental entity, IRA or an HSA, you use these three, you will have saved a substantial amount in taxes per year. And I can give you a prime example. I had 2 new clients that came in this year, and they both do really well, stable incomes. I looked at their retirement accounts, their 403b and 457 in this case, and they were hardly putting anything into their retirement, and they were making good money. I guess still are. And so I looked and I did the math, and by both of them maxing out their retirement plans at $23,500 if you're under 50 in 2025, they will save this year $11,280 from that one sentence that I mentioned. That doesn't even include the compounding effects, which I did the math just because I find this stuff fascinating. Over 30 years, and I wrote this down, I will save them from that advice to continue to do so, $1,065,517.67, give or take. Not that anyone's counting. And again, I didn't even talk about IRA, HSA. Those clients just happen to not have those at their fingertips. And unfortunately, they make too much money, so they can't get an IRA deduction. And so that's where we're talking about Roth IRA, backdoor Roth IRA contributions, things of that nature. But with HSAs, it doesn't matter how much you make. You can still put in that deduction. And admittedly, it's only a couple grand per person per year. But trust me, that only adds up in the long run for the tax compounding savings discussion. So we're going to take a quick commercial break. And then when we come back, we're going to talk about the most exciting thing when it comes to taxes, wink, wink, nudge, nudge, preparing for tax season. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the episode. I missed you dearly. We're going to get right into the nitty-gritty of preparing for tax season. Some of you may want to gouge your eyes out when you think about preparing for tax season, but after this episode, you're going to realize, in this segment in particular, it's not that brutal. Now, you still might want to gouge your eyes out due to the taxes that you owe, but at least you won't gouge your eyes out because of preparing for tax season, because it's really not that complex. So let's talk about organizing documents for tax season. Now, I don't want to overwhelm you because there could be a plethora of different pieces of paperwork that you will need depending on your situation. And I don't know your situation specifically, obviously, but the most common things that you're going to need to look out for are your W-2s from your employer, 1099s if you do contract work, investment statements if you have an investment account. You could have 1099-Rs for retirement accounts if you're taking distributions or if you're doing backdoor Roth IRA contributions. You may, if you have an HSA account, they send out another statement for that. So when you're getting all of these documents, I know what you're thinking. I don't want to even learn. I don't want to look at this. I want to just scan it into, if you do it online or if you have a CPA or an enrolled agent, you just send it to them. But take a moment, not a ton of time. You don't have to take as much time as I do because I nerd out about this stuff. But just take a moment and actually look at what's going on the paperwork. You see, the DOL and the IRS, they want to make these documents as easily readable for, how do I say this politically correctly, the lowest common denominator. So it's not as complex as you may think. There's just a lot there, but it's a lot of really surface level things. You don't have to think that profoundly about it. That's where your professionals get involved. And simply by doing that, you get to figure out and you understand that much more what's going on in the world of your taxes when these documents are coming, because then you can start thinking about the years ahead in avoiding taxes. Now, as far as choosing the right method for preparing for tax season, again, some of you like to use the DIY softwares out there, the TurboTaxes, the H&R Blocks, things of that nature. You could hire a tax professional from a private firm. Again, I'm not against anyone trying to do something for free, but it really does pay to have a professional help you out. And frankly, what I would do if you're really on the fence about it, just do it this one time. Go to an enrolled agent's office, go to a CPA's office before tax season gets in the swing of things, which is February 1st for all practical purposes through April 15th. The summer and the fall are great times. And your CPA or your tax professional can go and review the last couple of years. And I don't want to guarantee anything because I can't due to compliance, but I would bet a pretty penny that you probably will get some money back that you otherwise never would have recognized. In worst case scenario, you did everything right. Yeah, you're down a couple $100, but at least you know that you did everything right. There are tax challenges and opportunities that you need to be aware of. If you run a business or you're a freelancer, managing estimated taxes. So if you work for a company and you have your W-2, pretty cut and dry. You tell them how much you want to withhold and then you toggle back and forth. If you work for a company and you have your W-2, but maybe you have stock options, whether they're incentive stock options or non-incentive stock options or restricted stock units or stock grants. I know that sounds really, really complex, but if you're in that boat, it's really not. You get a W-2, you get a 1099 for your stock options, depending on what goes on. It's kind of beside the point. You basically have everything taken care of for you. You don't really have to track anything. But if you run a business or you're a freelancer, you want to make sure that you are not underfunding your tax liability. That's not great. So if you want to get uberly specific on it, after 1 year of your business, because frankly, here's the thing, if you're starting your own business and assuming you're not just like guns blazing out of the gate, Probably don't have to worry about taxes because you're not making any money. But after a year, let's assume that you are, you could set aside the percentage of your effective tax rate. Remember what I said at the top of the show? Your effective tax rate, and have that money pay for your taxes over time. However, I would conservatively take your effective tax rate number and bump it up to a round number. So if your effective tax rate is 18.3%, round up to 20 or even 25. And the reason why I'm saying that is, number one, you never want to underpay. That is really, really bad. Number two, and this is a compliment, if your business is going up and to the right and you are making more money, you're forward thinking about getting ahead of your tax burden, because you don't want to dig yourself out from debt for owing taxes. That, speaking from experience, that sucks. Like, working for your tax bill is the worst thing in the world, and it is depressing. As far as strategies for reducing your taxable income through investments, so I'm going to throw my industry under the bus. Not that I've done that ever before. A lot of advisors and even financial planners, unfortunately, a lot of financial planners, they try to get cute with taxes. And what do I mean by that with investing? Generally, they plan their years. And so October, November, December, they're incredibly busy because they need to take and do tax loss harvesting, which is, there's some merit to it, but it's basically an overblown fancy way of saying that if you have gains throughout the year, we need to take some losses because we have done so well. And there are some investments that haven't done as well. But in order to hide behind someone maybe messing up, what we could do is offset those losses with the gains and then avoid that much more in tax. And that way we look a lot more efficient and effective and busy than we actually are. I'm not against tax loss harvesting. I'm not against being prudent with looking at your portfolio and taking gains, looking at your gains, looking at any investments that you may otherwise not want in your portfolio for a number of reasons, and you take those losses to offset the gains. There is a balancing act between short-term and long-term when it comes to the gain side of things. And I mentioned that earlier with capital gains. Long-term capital gains, meaning holding an investment and selling it after it's been a year, versus less than a year, short-term capital gain, ordinary income, significantly less effective tax bracket. I will give you a specific example of an investment that most people would have said, oh, you should have waited to sell it after a year. But I actually didn't do that. And I'm not going to give you the specific investment name just for a number of reasons. This is not my jam. So there was an investment that was purchased for clients. And it was purchased for about $16. And it had grown in 10 months up to $37. So not including it increased its dividend a ton. So when you did the math on that, in 10 months, the stock was up about 120%. In theory, should have waited over that year, right? Because if you waited those next 2 months, myself, as well as clients, because I invest exactly how I would invest for clients in the long run. I always think that's the right thing to do, but it's neither here nor there. In theory, I should have waited the 2 months to take the long-term capital gain. All things being equal, I would rather pay 15% than 25% in taxes, right? Well, when you have a gain, this is where I get a little biblical with my faith here, but the way I look at it is, you have an investment. When you invest for the long haul, you are investing for that, the long haul, long term. I'm not going to give you a timeline for that. Warren Buffett always likes to say, I'll invest forever, which, that's pretty true because he's also lived forever. But think of just a very long time, 10 plus years. Okay. I'm saying that because if the big man upstairs has gifted you a future return and an extremely beautiful future return prematurely, why don't you be a steward of that gain and move on? Putting a quantitative spin on it, if you're up 120% and you are in the highest of highest tax brackets, forget like state and local like California, just federally call it 40%. 120 minus 40, you're still up net 80% in 10 months. Who in their right mind wouldn't take that? So I went against the grain with that. And why do I tell you that story? You need to have that balancing act when it comes to thinking about, okay, should I be penny wise and try to save for the next couple months a couple percentages on tax brackets? Or would I be pound foolish because if I wait those 2 months and the stock plummets, which this one just happened to do so, no, I had no idea that was going to happen, but sometimes you get fortunate. Even though you'd be at long-term capital gains, net of that, you're still way lower at your net overall return because you lost money relatively to the high earn. So I know that was really complex, probably got into the weeds a lot more than most people would like to, but go back and listen to this segment for a couple times until it's ingrained in your brain, because I'm just telling you what I've learned, not only for myself, but the best investors in the world. Any amazing investor would tell you that. Warren Buffett, Charlie Munger, Robert Hagstrom, you've got Guy Spear, Gautam Baid, Monish Pabrai, all of these famous, they would tell you the exact same thing. The exact same thing. Now, we need to plan ahead for major life events when it comes to navigating taxes. And you need to look into adjusting your withholdings when any major life event occurs. Now, what do I mean by that? If you get married, if you have children, if you have some major purchase like a house or a car that you can deduct through your business or a rental. I mean, there's a laundry list of big things that you could think of. If you've had any of these major events happen, there are tax savings that are dying to be had. So here's an easy one. Simply filing jointly if you're recently married. That in of itself is going to save you a boatload in taxes versus each of you filing single. And I don't need to get into the philosophy of why that is. I mean, because that's actually beyond the scope of today's episode. And that goes back to like our founding fathers. But moral of the story with that is, if you're not filing jointly, most of you probably should look into it. It's a really easy one. And again, talk to your tax professional if you've had any of these major events. One thing that's overlooked is tax implications with inheritances, home sales, retirement withdrawals. And I want to go over retirement withdrawals because those are frankly the easiest. With retirement withdrawals from an IRA or a 401k, those are going to be taxed at ordinary income. If you take the money before 59.5, you're taxed at ordinary income, plus there's going to be an additional 10% penalty. And if you have a 401k, there's administrative costs to that. So that's a big no-no. And that money is for retirement. So that should make sense. But 401ks, IRAs, ordinary income, cut and dry. With a Roth IRA and a Roth 401k, the pre-59.5 penalty still is in place. However, when it comes to the taxes, assuming you're in retirement, that money is tax-free. And I'm not getting into, there are some exceptions because you have to have a Roth IRA open for at least 5 years. let's just assume by the time you get there that that is the case. That money is tax-free. So we've gone over Roths, we've gone over pre-tax options, pretty straightforward. Now with home sales, a little bit more complex, but it's really not that hard. If you are single and you have a home and you sell it, the first $250,000 is tax-free if you have lived there for at least 2 years, and anything above the $250,000 gain is considered a capital gain. So a long-term capital gain, more favorable tax rate. If you are married, filed jointly, that gain bumps up to $500,000. I know it's brilliant. 2 people, 250,000 times 2 is 500 grand. Okay. But that's a huge deal. But again, home sales, pretty cut and dry. Inheritances, that can be a little tricky. It depends on where you're getting the inheritance from. So if you are getting an IRA or a 401k inherited, anything that comes out of that is taxed at ordinary income. And you also got to remind yourself too, with retirement accounts, this doesn't relate to taxes, but when you inherit an IRA or a Roth IRA, you have to distribute after the 10th anniversary of the death of whoever you inherited from. You have to distribute the whole thing. So what I like to do is I like to distribute the IRA equally over 10 years to minimize taxes. The Roth IRA, I don't take anything out, all things being equal. And then in year 10, you've avoided all of that gain and it's tax-free. So other than that though, with your IRA or Roth IRA that you inherit, that is taxed at whatever. It'd be no different than if it's your own account, IRA or Roth IRA. If you inherit non-retirement money, this is pretty interesting. Your basis, your cost of wherever your tax starts, it starts at the value of the date of death. So if you sold all of that money that you inherited today, assuming, you inherited all right now and you sold it in the blink of an eye, that's all tax-free. Now, if you hold the investments after the date of death, that's where the basis is wherever it was on the value of whoever you inherited it died. And at that point, it's no different than short-term and long-term capital gains. So before we close out the episode, I'll give you an idea. So let's say that, and I'm just going to pick my brother because he's on the other side of the camera. And I love my brother so much so that he will inherit the investments that I have grown over this hypothetical period of time. And let's say that I'm just an award-winning investor and I invested back in the day in, the next Amazon, and I put in $5,000, and I'm not going to touch this money forever because I love my brother that much and I want him to get all of it when I meet the pearly gates. And so that $5,000 grew to $1 million. I know it's an exaggeration. That's $995,000 of capital gain if I liquidated this between now and when I pass away. Well, good old Tyler inherits the money once it hits $1 million because I got hit by a bus or something. And Ty then could go and sell it at $1 million, and his basis is not $5,000. It starts at the day that I met Jesus. So that $1 million is tax-free. Now, let's say he held it. He didn't want to sell it. And then 6 months down the road, it grew to 1.5 million. I'm making this up. That would be ordinary income, that $500,000 gain. But let's say that over a year, it grew to 1.75 million, over a year. Then he would have a capital gain of $750,000. So that's really all that you need to know when it comes to the inheriting side of money when it comes to taxes. And that does it for this episode on how to navigate taxes and really everything that you need to know regarding taxes. I had a lot of fun with this. Like I said at the beginning, this was a loaded episode. And we always try to have loaded episodes, but I knew with taxes in the tax code, this one in particular was going to be a very advanced episode. So if you need to go back and listen to it a couple times, I highly recommend you do so. And you will thank me later on, A, when a lot of this is clicking, and then B, not only has it clicked, you get to tax season and go, oh, I remember what Chris was talking about. Oh, that's right. I am really thankful I did that because I saved 20 grand in taxes. So let me know if you have any questions. You know where to get a hold of me at this point, and my team will close this thing out. So as always, I'm your host, Chris Paniotto, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Paniotto, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Stock investing includes risk, including fluctuating prices and loss of principal. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. Christopher Paniotto is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. The people and or companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.